All right. Hi, everyone. Good evening again, and thank you for joining us today on our session with Dawn, BudgetBabe, the best move to make in a volatile market. To just kick things off and introduce everyone who's here today. So I'm responsible for investment research at Syfe, and before that, I was a product strategist and an index research analyst. And we have Dawn, who actually needs no introduction. I'm sure all of you guys know her already. She's Singapore's top female finance personality with over 17 million reads and counting. Yeah, and you can follow her on her blog or her Instagram. And next we have Samantha. So Sam is the Chief Business Officer at Syfe, and before joining Syfe, she was an MD with Broadpeak, a multi-billion-dollar hedge fund based in Singapore, where she managed a global consumer portfolio. And Sam started her career in Morgan Stanley doing equity research. So I think it'd be quite interesting to just hear that from her perspective, as well as Dawn, who's been investing for a very long time and also have a very wide following in the retail market. Right, over to you, Sam.
Great, and thanks very much. Thanks very much for that, Grace. So just a quick introduction on Syfe. So we are a Singapore-based and MAS and now SFC headquartered digital investment platform. So essentially, we build technology-driven solutions for everyone, really, to make investing accessible and affordable to essentially the masses. We have two main products. So our first product was Syfe Wealth, essentially managed investment portfolios. So for those of you who want a more hands-off approach and maybe in the context of today's discussion, also looking for ready-made diversified portfolio solutions. And our more recently launched Syfe Trade, which is a more active solution. So for those of you who want to take more bets on single stocks and ETFs, etc. So maybe to start off, we'll first do a quick poll of our audience. So first poll is, are you currently invested? You can click any of the following. So yes, with Syfe, yes, with other platforms, not yet, and not sure if I should start now, given the situation and the environment that we're in. And secondly, when did you start investing, if it is a yes? Interesting. So many people here are investors already, and actually, relatively experienced, right? So the majority 1 to 5 years. Some of you have just started. So I think very relevant for many of you on this webinar today. Great. So maybe to kind of set the context of where we are right now today, let's look at some of the market performances year to date. Given that many of you are in the markets, I'm sure many of you already know this, but we can see here that there has been obviously a very sharp correction. And this has been pretty broad-based if we look at the performances of some of the major and most popular indexes globally, right? So S&P 500 and MSCI World are both down 16% year to date. And actually S&P 500 did touch, the 20% bear market correction mark last Friday. However, slightly recovered since then. But when you look at the NASDAQ, actually the correction has even been, sharper, down 26%. And this is broadly a proxy for, essentially most growth and technology stocks, which we will touch upon a bit later as well. However, we should also understand this from, a longer term perspective, right? So if we look at it over a longer time frame, you can see here that actually, whilst this correction has been very stark, if we look at the likes of the S&P 500 and the MSCI World, actually, they've just given up back most of their performance from last year. Obviously, the correction for NASDAQ has been sharper, but again, coming from a much higher base. And if we look at this on a longer term perspective, they have still given us 7% compound annual growth rate for MSCI World, 10.5% for S&P 500 and 13% for NASDAQ, right? So this shows the power of long-term investing, and something that Dawn will touch upon a little bit later. But it also shows the outperformance and some of the secular trends that we've been seeing with growth stocks over the last few years, and particularly, since COVID. So growth stocks, and also I would add, mega caps, right? So the likes of Apple, Google, Meta, Microsoft, Amazon, Tesla, all the names I'm sure many of you, or all of you are very familiar with, actually make up more than 40% of the NASDAQ alone. And every year between 2015 and 2021, these mega caps have actually, lifted. Sorry, Grace, can we go back to the last slide first? So actually, over the last, 2015 to 2021, these stocks and these mega caps have lifted the S&P 500 higher, and excluding these stocks would have actually cut the performance in half, right? So very significant outperformance we've seen in these growth and mega caps. And why is this, right? So again, something that we'll touch upon a bit later, but growth stocks have been boosted by essentially long periods of low interest rates, benign inflation, coupled with globalization and COVID trends, which particularly led to a lot of us to stay home for the last 2 years. And obviously that's now reversing slightly, but that led to a major shift towards things like e-commerce, technology, SaaS. If you just think of the time spent here as we are today on in Zoom meetings, over the last couple of years, that can really show, how much our lives have shifted to some of these technology players, right? And this has made growth and tech stocks much more attractive, versus some of the other pockets of the market, such as energy or value stocks over the last few years. However, many of these trends are now reversing, and as we see on the next slide, that this has been even concentrated in some of the mega cap tech stock names. And maybe we'll just do another quick poll here with how many of you do these stocks here, as I mentioned, and I'll kind of touch upon why we're asking this question, but maybe hold more than 50% of your are currently make up 50% or more of your portfolio. So again, these are kind of, if we see the 10 names, I can call them out: Twitter, Apple, Google, Microsoft, Amazon, Tesla, Meta, NVIDIA, Netflix, Activision. Okay, so actually, that's pretty stark, right? So 30% of people, for 30% of people, it actually is over 50% of your portfolio. And almost 70% of people do hold at least some of these stocks. So whilst I know that this year would have been pretty painful, hopefully you have been invested for the longer term, and this is more, a correction for you, right? But why am I making some of these points, right? So if you look at growth stocks today, yes, these stocks and even mega cap stocks have seen such a sharp correction, right? And these stocks we actually picked out because they are some of the top 10 traded stocks and holdings of retail consumers, right? So it kind of shows you that how concentrated retail portfolios typically, can be. So maybe just a slight deviation here, but what are your key concerns perhaps in the market right now? I think you can tick single choice, so you only can pick one. And what have you done? So dollar cost averaging, are you sitting tight, still, wondering if it's the right time? Have you bought the dip? Have you bought the dip maybe multiple times? Gone into cash or still waiting? Pretty broad-based, but mostly around inflation and interest rate risk. So many people still waiting. Some of you gone into dollar cost averaging. nobody's liquidated to cash. So there you go. I mean, I think some people have been paying attention to us, maybe Dawn. So, but no, that's very interesting actually. Now maybe let's go to the next slide. So I know so far we've been pretty doom and gloom, but there are pockets of opportunity and there are pockets of outperformance, right? And whilst we see a lot of red on this chart, so this shows the sector outperformance year to date and calls out some, of the big names by market cap, right? So the size of the square, if you want to call it, is in relation to the market cap of that relevant company. But as we can see here, there are some pockets of green and there are some pockets of outperformance, and there are some pockets not just of outperformance, but of actually positive performance for the year. And if we call some of them out, as you can see here, it's healthcare, energy, commodities and utilities, and consumer staples. And what do these companies essentially have in common? So these companies are essentially what we call value stocks. Value stocks are made famous by Warren Buffett, and he was obviously a big proponent of value stocks, and they've somewhat gone out of fashion over the last few years. But as we can see, we can see why, if we look at some of the outperformance that growth stocks have had, over the last few years, essentially people have flooded into those stocks and away from maybe the more boring, if I say, value stocks, right? And these stocks essentially are companies, which you can see here, that are less dependent on economic cycles, are essentially items that people need at all times, even during a recession. And that's why we tend to call them as more, defensive stocks. And how do these compare with the characteristics of growth stocks that we were talking about in more length previously? So typically growth stocks have higher price to earnings multiples. And what that means is essentially people are paying more for the future earnings potential and cash flows of the company, which as interest rates rise, it is essentially less valuable today for future earnings that we have to discount at a higher interest rate. So that is one reason why people are moving away from growth stocks and multiples are coming down. The second big point here is differential between growth and value stocks is that whilst they have higher upside potential, typically growth stocks, because of the volatility of earnings, because of the cyclicality, etc. Essentially, they also have a higher drawdown in times like this, in volatile environments, when interest rates increase, etc. And on the flip side, value stocks are the opposite of that. So where they typically tend to have less upside potential, they also have less drawdowns in periods of volatility in the markets. Now, what are investors essentially been doing, right? So somewhat we can see from some of the outperformance versus underperformance in the various sectors. But if we look at fund flows, it's even more stark here. So as a proxy, if we look at a value ETF, VTV, right, versus QQQ, and look at some of the net inflows, year to date versus longer term, there is a big differential, and a lot of investors flocking into value stocks, right? So for NASDAQ, the QQQ, which is QQQ, we have only seen a net inflow this year to date of $92 million versus last year of $25 billion. So a very big reversal we're seeing here versus VTV, which has seen a net inflow of 11 billion year to date versus 15 billion for the whole of last year. So as we can see, there has been a rotation here, from growth into value stocks. And essentially, why has this happened, right? So as I mentioned a little bit previously, and Dawn will also touch upon later, is inflation worries and interest rates, going up. And if we look at the maybe the left-hand part of this chart first, this essentially shows that because growth, has had a long period of outperformance, we have seen that the relative multiples and valuations of growth and value has really disconnected, right? So value has gotten very, very even more value, so cheaper over the last few years in relation to growth stocks. And while this is now corrected a little bit, as you can see in that chart on the left, it is still a long way from the long-term average. So that implies that there is still some room for rotation further into value and out of growth when we look at multiples versus the where they've been over the long run. And on the right-hand side of this chart, we see that some of the value sectors, such as financials, energy, industrials, materials, commodities, also have a higher correlation with interest rates going up. So essentially, the backdrop is set for value to potentially continue to outperform as we go into a period of further inflationary worries and interest rate hikes. And whilst we say that, and whilst we've had these long period of growth outperforming, and now that reversal with value outperforming in the last 6 months or so, one important other point to make here is that if we look at volatility and risk and return over the longer run, areas and pockets like oil and gas and energy have actually underperformed over the long run. And where you want to be, so that's in the bottom right quadrant, and where you really want to be is when you're minimizing volatility and you're maximizing your long-term returns in that top left quadrant. So you can see here there's likes of healthcare, software, aerospace, etc. And the point that we want to make here is that there can be pockets of outperformance in various sectors and in various types of stocks, so growth versus value and cyclical versus defensive, etc. But essentially, diversification here is very important, right? Because if you don't catch those pockets, it can be challenging for you as an investor. And on that note, I'm going to pass over to Dawn.
Thanks, Samantha. Yeah, so exactly. I think one question that we should really ask ourselves as investors is how much time do we spend sitting in front of our laptop or our apps, tracking all of the changes and acting fast enough to catch it whenever those pockets of opportunity arise. So we can set order prices, but most of you guys who have invested for a while, you would also know that we tend to sometimes also adjust our price expectations or price targets of what we want to go into when we get new information or new news. So some people prefer to just react and then set, but the problem with that is unless you're almost a full-time trader, it can be really hard to catch those pockets of opportunities. So in tonight, what I wanted to run through is really the fact that on a macro scale, because things don't look very pretty, I think was it just yesterday that Malaysia announced they're even going to be pausing and reducing a lot of the chicken exports. So we're going to have a chicken shortage in Singapore soon. And prices are going to rise even more. Bad news for those of us who like to eat chicken. And aside from that, we've all seen, oil prices go up. Our grocery bills have gone up, our electricity and utility bills, all of this have gone up significantly in the last few months, and it doesn't look like that will taper off anytime soon. Initially, people thought that the Russian-Ukraine war aggravated a lot of it, but I think beyond just the war, there are also many other factors that are contributing to all of these inflationary pressures. So it's going to take a while until that passes. And the thing is that if we look back in history, there's always been macro bad news. So it may not look pretty now, but it has also been similar at different points in history. So that's one thing that we want to be considering as investors. The next slide, basically, what is the sentiment of investors in the market today? I think it's interesting that the CNN Fear and Greed Index has actually recorded single digits fairly recently, last year. As of now, actually, let me just do a quick check. So right now, as we speak, I think with yesterday's market's volatility, it is still at extreme fear. It's at 14. So still in the really negative zone. And typically, what many of us who have been watching this index would also observe is that when this is in the extreme fear zone, that's when a lot of opportunities can typically be found in the stock markets. So whether or not you're in individual stocks or you're looking at ETFs or broader sectorial teams, this usually signals a good time to go shopping. And then when it moves to fear and neutral, there can still be bargains, but slightly less. And then of course, when it goes to greed and extreme greed, that's when valuations get pushed up sky high, as what we saw happen in the last 2 years after the COVID recovery took place. So what should we do next, right? I think that's the question that we're all wondering. And I think if we look at what happens to stocks when interest rates rise, the thing that we all know is the cost of borrowing goes up. So companies that have higher debt will suffer because you have to pay more in all these interests. And if they haven't hedged it with different payment terms, then this is where we'll start seeing the numbers show up badly in their books and quarterly earnings soon enough. At the same time, profit margins also tend to go down because higher cost of borrowing, but also don't forget that when interest rates rise and a lot of your growth is being fueled by debt, then your operating costs and all of that also goes up. So when you net things out, the profit margins are slightly lesser compared to when interest rates are low. And we saw that happen in the last few years when we enjoyed low interest rates for almost a decade. So a lot of growth stocks were very sexy, managed to grow tremendously during this period. But ever since the Fed announced and started hiking the interest rates, the valuations for these companies have taken the biggest hits. And why is that so? Because many of the formulas that are being run by analysts to project what a growth stock is worth have to use some of them use the DCF, discounted cash flow method, some use other valuation models, but they all look at future earnings. And if interest rates is higher, then you have to discount that future earnings because they're no longer worth as much anymore, given the higher interest rates, right? So that explains why tech stocks especially have dropped so much in the last few months compared to some of the others. But one thing that I would like to highlight is that this will not last forever. So high interest rates is also not good for a country's economic stability. It causes a lot of unrest and unhappiness, and it is in a lot of governments' interest to keep interest rate low or at a sustainable level that isn't too painful for everyone. So, okay, sorry guys, that was my kid. But yeah, so what we want to look for is companies who have strong finances, look at their financial statements, look at the cost of borrowing and their debt levels. Ideally, I think the best company in such an environment is one that has virtually zero or very low debt and generates enough cash flow from their own operations to cover any debt obligations that they have. Okay, can you find Daddy first? Can you find Daddy first? I will go to you later, okay? Sorry guys. All right, so the next thing is then what about inflation? So that's for interest rate, right? when inflation gets worse, and it will likely be the case in the next few months, it actually causes the price of goods and services as well as supplies to go up. We're already starting to see this because if you go to the food courts, the restaurants, almost every other business is announcing higher prices right now. So businesses that can pass on these higher operating costs to their consumers are the ones who will make profits. So I'll use Apple and Microsoft as an example. Apple has raised their prices for iPhone multiple times over the years. I remember not too long ago when people used to say that paying $1,000 for a phone is just pure insanity. Look at where we are now. And what about Microsoft? Microsoft, who functions both in the consumer and B2B space, it's not like we're going to stop using Microsoft services and Excel and PowerPoint just because they increase their price by like $1 or $2, right? We will still need it. And if it's a business expense, we'll just claim it back from the company. So these are just some examples. I mean, there are many other strong brands out there who can raise their prices. And I think one thing we want to take note of is what happens before and after the change. We want to make sure that to confirm they are able to really pass on the prices to the consumers, we would need to monitor it for several quarters in their quarterly earnings after that. Because if you start to see the initial one is still okay, but then 2 or 3 quarters later, you start to see the revenue go down, then they haven't really been that successful at passing on prices. Some consumers are starting to drop off. Then that's where we have to see how's the business going to react to that? Are they going to drop their prices again? Or are they just going to come up with different strategies to try and win those consumers back? So I think the other thing is, a lot of people have been saying, and traders especially, have been telling people that when inflation gets worse, your best defense or insurance is your consumer stocks. But the market got a shock last week when we saw that even consumer retailers, after announcing their earnings, didn't do very well. So typically you would think that in a recession, in inflation, we still need to eat, we still need to go to the groceries, and these are necessities. It's not like, optional spending, right? So we still have to buy our eggs, even though eggs have gone up in price so much in the last few months. But even these retailers are starting to find issues because the increase in the operating costs is just going so fast that some of them are unable to predict it in time and adjust in time. So what happens is that I think Target's earnings really shocked the market. They're down by nearly 38%. If you look at the chart, that's a really sharp drop. And even consumer brands are not being spared. I think anyone trying to look for like a flight to safety now is kind of a bit hard to be sure that just because you think a sector is going to be okay, then you go and you shift your eggs out of your current baskets into that one, but that doesn't necessarily give you the guarantee. I think rather than trying to keep, switching around and trying to be one step ahead of the market, I think the most important lesson, and if you guys have heard me speak before, you would have seen me emphasize this multiple times over and over again, is that timing the market always beats timing the market. Not only is timing the market incredibly difficult, but if we get it wrong, then there's a study that also shows that investors who miss out on a few of the best performing days of the markets had their returns massively impacted. And I want to just highlight one thing, right? You see, when you want to time the market, it's always easy to say, but difficult to do. Why? Because did you realize that you have to get it right more than once? You have to be able to get out and get in at the correct time. So you think, let's say you expect that prices will go down. So you listen to some guru's advice or some influencer or YouTubers advice, and you liquidate it into cash, and then you wait and hope that you can buy in more later on when the price is down. What happens is that when you liquidate, you need to also be sure you can catch it when it's down. And if you miss that, then could there be a chance that you'll be buying higher at what you let it go at? it's just really, really hard. So I think the easier thing to do really is just stay invested rather than try to time it. And on the next slide also, you can see that the percentage of positive years in the market is still overall 3 out of 4 times, 74% of the time. So if we just continue to dollar cost average and just keep going the same strategy, of course, the bear market is a good time for us to review our strategy to see if there might be any gaps or things that we need to fix. But just stay on the course, and the chance of us coming out in the green is going to be much higher as long as we do things right. So this year is a year where the S&P is negative. A lot of indexes are down. Hong Kong stock market is also down by a lot. The US has been so badly hit as well. Maybe it's just that 1 out of 4 times. It's just that 26% of the time that we're seeing now. We just have to get past it. And if you want to try and time it, then you have to ask yourself, getting out at the 26 and then getting back in again when it is still 26, instead of only getting in when it's back to the 74% green, can you really execute that? I think it's really, really hard. So the best advice is to dollar cost average. And if we look at dollar cost averaging and the power of it, right? Imagine if you had invested a hypothetical $1,000 in an S&P 500 index fund. So on this next slide, you can see initial one, 1,000. And then after that, every month, let's say you just put in $100. So there's this study that actually showed if you had done this between March 2009, remember that was coming out of the major global financial crisis as well, and then continued. And during that time, things and the sentiment was a lot bleaker than what it is now, right? So if you started that March 2009 and just did it all the way until February 2019, before the COVID pandemic then, you would still be up by a lot. It's 12%, almost 13% over the years. And would have been a really easy strategy to do that you don't have to really, keep thinking about. It's just one time 1,000 every month without fail, no matter what happens, 100. So of course you can change the amount to what fits your risk appetite and your capital. But the idea here is that when you do dollar cost averaging, it's not only better in the long run, but it's also easier. And more importantly, it helps you to also focus on the other things that you need to pay attention to, like your kids, your work, your business, growing your business. Surely, unless you're like 100% trader or investor, most of us have lives outside of the stock market. So DCA is a really good strategy for many people. And there's a reason why it is so timeless. So BlackRock also did another study, and it shows that the longer we invest, the lower the risk of losing money. This time horizon was measured between 1926 to 2019. And you can see that if you are invested only for 1 month, if you hop in and out of the market, right, and you hold your position only like for 1 month or 1 year, okay, your chance of losing money is actually higher versus if you just hold on for the long run. Of course, this is based on the assumption that you have done the fundamental analysis right, and you're invested in good, strong, fundamentally strong companies. But the idea here is that over a longer time horizon, things usually look so much better. But if you want to try and get in and out and just stay invested for 1 month, everyone wishes that they caught the GameStop hype, they caught whatever stock doubled in a month, or any of the news headlines you saw, right? Everyone wishes they caught that, so do I. But it's just incredibly hard. So instead of trying to catch that all the time and failed, I mean, if you just look at GameStop, how many people managed to make money from it versus how many people who lost money from it? I think the latter group was a lot more. This is based on what I've seen and heard from you guys, as well as what my friends around me have done. So it's gambling if you try to time it in that way. But if you DCA, I think it's better for our sanity. And in the long run, we're also more likely to come out top. So the last thing I wanted to emphasize is that it may seem really scary, really bleak right now, but a lot of us are of the view that in this kind of climate, that's when bargains can be found. So when the markets crash, when the markets are depressed, when valuations fall, this is when we have that opportunity as an investor to get in and ignore what Wall Street is saying. Just because, say, a stock announced negative, lesser than desired or lesser than expected earnings this quarter, the market goes on to then punish them severely, and you see like a double-digit drop just overnight. We've seen that happen so many times in the last few months. But there are some companies where this is really just temporary, and they will be able to overcome it, and then the stock prices start recovering a few quarters later. So we're able to discern between the noise and what are fundamental truths for the company. Then that's where we have that chance to get in when the market punishes the stock price so badly that it falls below the intrinsic value. Of course, you will need to know what the intrinsic value is in the first place, which is why fundamental analysis is important. And if you find it too difficult to analyze individual stocks, there are also ETFs. So I have a portfolio of ETFs set up on Syfe as well, which is basically, the don't really have to think approach for me, because I look at sectorial trends, and it's easier to analyze an ETF and just overall team rather than individual stocks per se. So I do both, but it's up to you whether you want to employ both as well or just focus on one, and at the end of the day, focus on what works for you best. So yeah, don't be depressed, and don't be so quick to liquidate everything and go into cash, because if the market recovers next week, can you react fast enough? If your answer is, I'm not so sure, then maybe it'll be better to just continue DCA, stay the course, and keep watching the news, keep watching the announcements from the companies or ETFs that you're invested in, and then adapt accordingly. That's the best strategy that we can offer. That's for my segment. So I'll pass the time back to Sam. If you guys are a Syfe user, or even if you're not, what I think is useful is that on Syfe Trade, you can get actually lots of ideas, and she's going to walk you through how you can use that to do some quick analysis, even while on the go, like when you're on the train or taxi. So over to you, Sam.
Thanks very much. Thanks very much, Donna. And yes, 100%, agree with your sentiments, DCA and time in the market, etc. And as Dawn mentioned, right, I think if there was a segment of you who maybe haven't started investing, and for those of you who essentially have a significant amount of your portfolio that is in these concentrated growth stocks and big large mega stocks, as it seemed like from some of our polls, what are some of the ways to maybe learn about new stocks, right? See what are some of the trends that are happening, in the market right now. Where are these pockets of outperformance coming from, right? And what are some of those stocks that you can play versus perhaps, some of the stocks that you're very, very familiar with in your everyday lives, right? The likes of Google and Apple and Tesla, et cetera, right? So in Syfe Trade, one way you can do this is essentially going to our Discovery tab on the bottom of the app, as highlighted on the screen. And there are a number of different lists, which can help you get started, both with general investing and also, rediversification as we're talking about, right? So one of those examples is, last 12-month winners, right? And here you can actually see where, some of the top performing stocks are, and as you can see from the screen, right, most of these are actually, energy stocks right now, right? And that's where you can get an idea of where to invest and diversify, a little bit of your portfolio. And likewise, you could go directly, to some of the themes that we have, and here, also what we've called out in terms of value stocks, and you can get, a list of these stocks which have been, the more boring or maybe ignored stocks, over the last few years, and particularly into COVID, right? And some that you can see here, some of Warren Buffett's favorites, General Motors, AT&T and Ford, etc., which I don't think many retail investors right now and particularly maybe our younger investors, have spent a lot of time on in the last few years. And one other way is through sectors, right? So as we mentioned, some of the pockets of outperformance you can see here, energy stocks, right? What are some of the top market cap and performing energy stocks, healthcare, consumer staples, also known as FMCG, right? We can have a list. We have lists there of those stocks, which can also, help you get ideas to further diversify your portfolio, and ideas even to dollar cost average into. And I'll just touch briefly upon some of the key features of Syfe Trade before we go into Q&A. So a few of them is one important one is fractional trading, and this really alludes to the diversification. Sorry, that we were talking about previously, because you can buy essentially in dollar amounts, and you can buy many more stocks potentially for the amount that you are looking to invest, right? So if we look in the context of some of these mega cap stocks, which traded a few $1,000s per stock, you can, with fractional trading, essentially invest $1,000 and have an equal allocation of, say, $100 in 10 stocks each. And that way you can really get a truly diversified portfolio versus having to buy essentially on a single stock basis, and have one stock that is essentially the lowest allocation you could get, maybe $5,000 versus other stocks at a few $100s, etc. We also offer free trades every month. We have SIPC protection of up to $500,000 for each individual account. And essentially, one of the main features of Syfe Trade, it's a very simple to use interface and very good for anybody who wants to start their investment journey or just wants a simple to use platform. So as an introductory offer, we offer 5 free trades for the first 3 months for any new users. And then every subsequent trade after that is a flat price. So no other fees charged here. So no custody fees, platform fees, etc. And that's a price of 99 cents per trade subsequently. After the 3 months, we still offer free trades. We offer 2 free trades and then $149 per trade subsequently. But again, no other hidden fees here. I think now we're ready for some Q&A. Grace.
Right. Yeah. Thanks, Sam, and thanks, Dawn. I think it's been quite interesting, and I'm going to just kick things off. We have a few questions coming in, but just wanted to start off with, trying to draw a comparison between, Sam, and your previous role of a hedge fund, working a lot with institutional investors. Could you talk a little bit about how you think that's been quite different versus retail, and then also the follow-up question to Dawn is, how have you navigated the recent sell-off, and what are some lessons you've learned earlier on? I know you've been investing for a long time that you think you could share with our viewers today. So yeah, maybe Sam first.
Sure. And thanks for that, Grace. So I would probably allude to what Dawn mentioned earlier, how much time do you have thinking about it, concentrating on the markets, looking at all these trends, understanding why stocks are outperforming, what potentially could lead to a change in that outperformance in that particular stock or sector versus another. I think as an institutional investor, of course, that's all you spend your days doing, and you have significant amount of resources in which to do it, right? Your access to information, etc., is all very, very different, right? So I think as a retail investor, to offset some of that, what we do have to do is some of the points that we mentioned, right? Diversification, dollar cost averaging, and not trying to time the market. Because yes, if you are in a hedge fund, you are essentially having to play for very short-term performance. You are judged on a monthly basis, for sure on a quarterly and annual basis, and you're incentivized very different very differently to really optimize, for that short-term performance. Whereas, retail investors, and for many of us now, we can take a much longer term perspective, right? We can afford to have, some periods of drawdowns, volatility, and, be able to ride them out if we are diversified, if we are disciplined, in our investing, and, can basically ride through, those drawdowns. For some, hedge funds and institutional investors, you cannot afford those drawdowns, essentially. And that's a very different mentality, right? Versus retail investors.
Yeah, exactly. I think a lot of retail investors try to act or get the kind of results that hedge funds typically do without putting in the equivalent kind of resources, be it in terms of paying for paid data, a Bloomberg terminal, or even just the hours that they spend monitoring and adapting to the markets. I think we really need to understand what our strengths and weaknesses are and then play our own game. So yeah, I think Sam got it spot on with that difference between hedge funds and retail. So yeah, Grace, to answer your question, so I think the biggest lesson I've learned over my investing journey is that it's just really hard to time. I think all of us start off thinking that we have this power to time, because when we look at hindsight, it always looks so obvious, right? On hindsight. So we start thinking, we look at history and we're like, oh, that's pretty obvious. I would have done that if I was in that position. And then you go in with that mentality and then when you try to execute, you realize that, oh, black swan events happen, unexpected stuff, throw you off course. And then you start to become more humble as an investor and realize it's really not that easy. No wonder everyone else always says, don't try the time. So I think having gone through that lesson myself, even though I knew it, I still wanted to try, right? And I did try for a short period, and I concluded really it's just so incredibly difficult. So I try to save time by teaching and telling other people and my followers, don't bother. Yeah, if you really want to try, even just a paper trade account would likely give you some sort of idea how difficult it is already, but the emotions adjusting part is going to be very different. So there's going to be some stark differences that you'll observe. The other thing I realized is that it's really important. So when we are in a season of bull market, it's really easy for people to get drawn to sexy narratives. And I think we saw that a lot in the last 2 years. It even got me thinking during the last 2 years and questioning myself if maybe what we knew about investing and learned all this while needs to be updated. Maybe one of the new criteria in our investing checklist should now be, what is the market sentiment for this stock? Are there any triggers that could change the sentiment of this stock? And then, of course, the Fed started hiking interest rates, and we soon started realizing that no, even the most overhyped, most optimistic sentiment will still lose strength when dealing in the face of inflation, war, rising interest rates. So that's something that I hope people will take away as well. It can be very easy to be drawn to sexy narratives and to want to switch your strategy. It's also what a lot of the financial education or edutainment on YouTube and TikTok algorithms are designed with, right? Because you'll say, I made 3x my money, 10x money on this. But by the time that has happened, and if you try to go in, typically the valuations have already gone up. So it's hard. Most of the time, if you didn't spot it yourself, you heard it from someone else, there's a chance that you're already too late, just like what we saw during GameStop. So I think that's some of the biggest lessons I learned, and just stay the course. That's the most important. Find what works for you and stay the course.
Yeah, thank you, Dawn. If I could just have I think it's an extension, but we have a question about, as complete newbies, how do they even figure out what works for them, right? I mean, without going through this trial and error period of finding out what are some ways that they might be able to get to that point, earlier.
Yes, I think we all start off as a complete newbie, so don't let the term newbie daunt you. It's easy to be really overwhelmed by all the information that you find online. I think the most important number one advice, right, is figure out what works for you. So ask yourself questions like, how much capital do I have? What do I like looking at individual stocks, and am I prepared to spend the time researching and monitoring them, or would I be better off with, say, an ETF? How much diversification do I need? Do I need asset allocation across different stuff like equities, bonds, and so on, gold? Or am I comfortable to take on like a 80 or even 90% exposure to equities and then be able to still sleep at night, even if that drops by a significant percentage in the next week? So asking yourself those questions and figuring out how you react emotionally when there are increase and decrease in stock prices is important. That will help you to then find the right strategies. And it's going to be a learning journey. Yeah. The secret is that nobody figures it out the moment they start. And I think even all of us here on this call, even for myself, we're still adapting to new information every single time as we go along. There's never 100% that we can know about anything. Even Warren Buffett has said that he's still learning so much, and he's already spent like almost his entire life and career in investing. He's still learning so much. So it's just not possible for us to finish everything. Just always be ready to adapt in the face of new information.
Yeah, thank you. That was very encouraging. All right, I think of one that you said that we'll answer live, and that's, if given the option of either lump sum or DCA, yeah, how would someone decide, like, if I have the same amount of money, which one should I go for?
So my question back to this attendee then would be, how do you know this is the bottom? What if it continues to drop? We all thought that the tech stocks had already dropped so much, like what, 30%, 40%. They continued to drop even more in the months after that. I think it's really hard to know when it's the bottom. If you think it's the bottom and you're willing to put your money to what your beliefs lie in, then yeah, I guess a lump sum now would work. But if you're not so sure, then maybe having more bullets would be good. So I'll share an anecdotal story. When the COVID crash happened in March, right, I was really excited, and I was like telling my husband, hey dear, the crash is finally here. I waited so long for this. I have so much bullets saved up. I'm going to start, firing my bullets and putting cash in the market. And then I fired 2 rounds because it just kept dropping, right? And I was like, oh no, it's still dropping. Okay, maybe I should start to space out my purchase now because I don't want to run out of bullets so quickly. And then we all knew what happened. Boom, the market recovered so abruptly. And I missed the chance to go in even more. And of course, like I knew, and that was the strategy. I was prepared. So yeah, but we all wish we could go back and do things differently. But you see, that's just hindsight talking. So the same question here is, if today is the bottom, we'll be glad that we lump sum. But if today is not the bottom, things get worse, or sentiment continues to stay depressed for a while more, will you regret doing lump sum now and not having enough bullets saved up for later stage when the prices continue to drop so you can average down even more and make your entry prices cheaper? So you have to answer that question for yourself and then put your money where your beliefs lie in. Yeah, but what about Sam? How do you approach it?
I think that essentially, yes, as you said, right? I think actually when you get to that max fear point, it is definitely much harder than it seems to invest, right? So I think being very disciplined and not trying to time again, as we say, right, is very, very important. I thought I bought the bottom multiple times in this last 6 months. And the bottom keeps on coming. So it's definitely a case of not spending all your bullets at once, and being disciplined and investing on a regular basis to make sure that the bottom is actually maybe not is not too far away from when you first thought it was, right? So definitely that is my view, and I've definitely learned that in my days of retail investing versus, my days in institutional, when I had a lot of time to, closely monitor the markets and react very, very quickly, right? As an institutional investor, you would intraday trade, right? You can have a lot more ways to mitigate your risks. You can hedge, etc., which is not available as much to retail investors, right? So therefore, you have to be very disciplined, with the way that you invest.
Okay. Yeah, thank you. I do have one question, but I'm not sure whether I'll just read it out as it is. And I think Don, you said you were going to answer this. So I think if we think that the answer was maybe not clear to the question, you can add the question again. But would you recommend us to invest? What are your thoughts on buying just stocks and ETFs in the Singapore market? Is it a big no-no?
As someone based in Singapore, most of us would want to be operating in our home ground advantage, because part of our fundamental analysis on the companies would be like, you can go and literally see with your own eyes how crowded the mall is, or if that brand is really selling, so on and so forth, right? So like, let's say if you want to buy Old Chunky stocks, you can go down and monitor if there's really a crowd and demand for Old Chunky products, compared to just reading and believing whatever is being said on their annual reports and earnings call. So the question here then would be, if one is comfortable to just invest and have exposure to just one country market, then I think it's fine. There's nothing wrong with just buying stocks and ETF in Singapore. But if someone wants global and a lot of the growth, there's only a limit to how much the Singapore market can grow. Even REITs, we're seeing them start to expand overseas now into Europe, into Australia. So I don't think that limiting yourself to just Singapore market is a bad idea, because you can still get global exposure, but you're going to miss out on names like Alphabet, Amazon, and all these big blue chip growth conglomerates who have very strong pricing power, more so than many Singapore brands, and who are still expanding and still making a lot of good money. So it's just a different market, a different approach. Personally, I think that getting exposure to different countries is a good way to go. So I personally am exposed to Singapore and Hong Kong, which then gives me exposure to China and also US for more global stocks. Yeah, but go with what you're comfortable with.
Okay, yeah, thank you. So we have one question on just sort of like where to find information. So a lot of stocks are in the red now, and so are cryptos, but the money has to go somewhere. How do you track where money flows are going, and how much consideration we should take, when we're making our decisions? If I could just start first, and then like Don and Sam, if you want to add in, please do. Yeah, so I think for the slide where we showed like the two ETFs, right? We're sort of using them as proxy for value and growth. Yeah, I think that's available online for free. I think I use ETF DB, but there are a lot of different sources. Also, there are these like research websites like Morningstar, and then some of the similar websites where they would publish like fund flows over different time periods, and I think they do it like either on a monthly, but definitely a quarterly basis. So if you want to get some information there, that's where you can go. And then I know we also answered that, if you want to like look at individual stock trading volume, that's also possible. Yeah. If you guys have anything else to add.
No, I think that's
okay. All right, I'll go to the next question. Okay,
if I can jump in real quick on that,
yes,
to add on that question, right? I get where the person asking is coming from, because a lot of some advice is that you should follow where the big money flows. But again, I think that's like trying to play the hedge fund game versus the retail investor game. Can you track accurately? Are you subscribed to the right tools? Are you monitoring them quickly and regularly enough? Are you then adapting and reacting fast enough? So if they've already exited, maybe the price would have dropped by so much and you're just left in crypto speak holding the bags, right? So it's just really hard. I feel that the easier, a more sustainable way, especially for a lot of retail investors, is really to just focus on the fundamental analysis of it rather than trying to, play the hedge fund games without the kind of resources that hedge funds have.
Okay, yeah, thank you. We have one, I guess, two somewhat like macro related questions that yeah, Don and Sam, if you guys want to start first, and I can add on. So the first is stagflation possible even if the Fed is trying to prevent a recession?
I can maybe I can jump in there.
Okay.
Yes. So I think we are actually quite close to a technical stagflationary environment right now, right? But I think this is more a case of where is expectation versus versus where the market is, right? I think actually many people and the market does think that we are potentially going to enter a stagflationary environment. The question is more, how long does it last? If it is 2 quarters and we can then recover from it, and a lot of these supply chain shocks come off potentially, and inflation starts to come off, do we see a very quick recovery, right? Or does this take a little bit longer, right? I think that's more the question. And really, when we think about market moves, it's about where is expectation versus how we are tracking, right? So I think a lot of the market already expects that inflation will continue to be an issue, and interest rates will continue to go up, and growth is going to slow. More of the question here is how long, and that's why it's very important to not time the market, because I think none of us have a clear answer to that question right now.
Yeah, even the economists themselves are divided. Yeah. You can't find everyone agreeing on one stand whether or not stagflation is going to happen or not. I think the other thing to know is that, look, even if stagflation happens, it's not going to be permanent. It's not going to last forever. Are you the kind of investor who are going to be focused on picking the best kind of companies to invest in and stay in for the long haul? Or are you going to be that investor who keeps switching your portfolio every single time macro factors shift? So that's something you have to ask yourself. Yeah, I think it's so hard. We don't know. So rather than try and make decisions on things that we don't know, what about making investment decisions on things that we can know and can go and research instead?
Yeah, definitely. Because the follow-up question was like, how long do these factors last? And it always depends, right? That even if you can look at like past analysis and all that, but the drivers could be different, right? The world is different now. I think people have compared like this to the early 2000s, and then occasionally like the high inflation period in like the 1980s. But these are like very different time periods, right? So you can do a lot of research, like that's what what I do a lot. But yeah, I mean, there's no way to know. And then I think it's very important that we do the best we can, like sort of make sensible decisions, DCA, and then be diversified. Yeah, if we do one last question, and that would be, what should we look out for before investing in stocks? This is more a question for Dawn.
That could be like a 10-hour workshop.
I know, yeah.
So I do have a course on that, but I think you can go for either free or paid sources. So if you want free, then I have a list of recommended investing books on my blog. Just search BudgetBabe, BudgetBabe recommended investment books. You'll find a whole list. Once you've read through that whole list, I'm very sure you're going to have so much wisdom as an investor to get started. So that's one. Another way is if you can start identifying paid courses or workshops to try and shortcut your learning process, because you can get done with them in just a matter of days versus taking a lot more time to read so many different books and get so many different perspectives. Courses kind of distill that into a syllabus for you, and it helps you to not have to worry about things that are outdated or things that are just noise. So that's one way. So go with what capital and what resource works better for you. But just to get off the top of my head, just some answers. I think it's quite common that for a lot of the value stocks, we would look at how undervalued they are. Sometimes we use price to earnings ratio to measure that. Sometimes if it's, let's say, a REIT or real estate, we would look at the net asset value. If the company has a lot of tangible hard assets, we would look at how much are these assets worth, the depreciation rates, and calculate all that different assumptions to get rough figure and then, divide it by share price and kind of figure out where you are right now. Sometimes for the banks, it's like looking at book value. So there are many ways to value a stock and what to look out for. If we're not looking at exact metrics, I think the qualitative side of things is, do you understand the business? And on my YouTube, I've actually done a 3-part series on how to analyze stocks in this way. The only part that's missing is valuations. I promise to get that up sometime. But yeah, so do you understand the business? What is the business? How does the business make money? What is their operating costs? What factors affect this? What is their competitive advantage? What stops someone from creating an exact same business and competing with them at a lower price? So what is this economic mode? What are the factors that can actually fuel future growth? What are potential risks and challenges facing this company? So these are a lot of qualitative questions that are not exactly a textbook answer and not as straightforward. You have to read through a lot of, say, earnings transcripts, the annual report, sometimes even reading through, do a SWOT analysis, SWOT analysis, even researching the competitors sometimes to understand the competitive mode, right? So there's a lot of things that you want to look at, and it's easy to get overwhelmed. My advice is, I find the best way to come up with a checklist of your own. So some trainers would spoon feed you a checklist, but even when I've gone for courses in the past, what I like to do is I take some things from their checklist that I like and I put them into mine. And over the years, that has really just shaped my lens on things. So I run a Patreon where I actually talk about, I outline the entire thesis of why I invest in a stock. And I find that, over the years, while that has changed, it really just boils down to what is the business, what are their risks, the challenges, what is their competitive advantage, and what are their growth. And then, of course, compare it against the financials to make sure that when they tell you a sexy story, the numbers show the proof. Yeah, so those are just some stuff off my head. Sam, is there anything you think this person should know about what?
No, I mean, typically, I totally agree with you, right? And one thing that I will say, and caveat it with another thing, but is invest in what you know, right? So invest in a sector, in a company that you're familiar with, because you're much more likely to do the work on it and to understand it, right? And to stay on top of those trends, etc. So trying to invest in things you totally don't understand is never, highly recommended for a beginner investor, right? The second is, as we've kind of mentioned many times before, not to put all your eggs in one basket and to diversify, right? So, as you're starting out, very important that you don't just make, big concentrated bets, because it is a learning journey, right? Investing is definitely a learning journey, and you will learn a lot, over the years, right? And remember all your good calls and your bad calls, etc. So, very important to keep that in mind and stay diversified again.
Yeah, I think Warren Buffett had a term for that, circle of competence. But I think aside from staying within your circle of competence, which is really super important, the other thing I find as well is that when we try and research into something that is out of our circle of competence, we get bored really easily.
Yes.
Yeah, and
exactly.
we make false assumptions. We jump to quick conclusions that may not always be true. And I'll share with you guys a personal example. So when oil crashed was it 2016 or something, right? The previous oil crash, not the recent one. I was like, oil will definitely recover. Our world can survive without oil. So I bought into oil stocks and I went to research and I thought I understood oil stocks. It was only after they started, they didn't have that kind of huge profits that I thought I would make. And I was like, wait a minute, what's wrong with my thesis? What's wrong with my analysis? What went wrong exactly? And I went in to really deep dive, and then I realized that, it's not that simple as the world needs oil. This is a good oil company. So I realized that there's just so many stages of the oil processing, and the different package, like the different players in the entire oil supply chain. There's just so many stages, and I didn't know of this before. So yeah, and I concluded after that, I'm just not going to touch oil. Like I get bored. I don't understand it well enough. And it's okay to stay away from investments that you don't like, you don't have a passion for, or you don't really understand, because it's also safer that way. Some people have like a huge portion of their portfolio on Tesla. You see them posting videos about how they made it big. Great for them. But let's not forget also, like what Sam said, if you're overtly exposed to one or two stocks, yes, you can 5x, 10x your money very quickly, but it can also go the other way. Losing 80% is very painful if you have so much exposure to just one. So I think let's not be greedy. Yeah, always consider both the upside and downside. And I quote Warren Buffett, take care of the downside and the upside will take care of itself. I think a lot of investors who started investing in the last 2 years, we're only seeing the upside because the market was just on a rampant bull in the last few years. But now we're starting to see the downside. It's a good time to ask ourselves, are we comfortable with the downside? If we're not, then maybe it's time to go back and look at what Sam said about the different sectors and see if I need to diversify into something else.
Thank you both. If I could just sort of put it in a different context, because we got a question about CPF. So would you recommend investing with CPF if we're new, and also new to investing and also looking to buy an HDB in the next few years?
I guess, I think that if you think about CPF, it is actually, our perspective is that this is a very rare component of your portfolio or your wealth, essentially, that can get a guaranteed rate of 2.5%, right? There are none, if I very, very little, or if any, other vehicles and assets which can guarantee you, 2.5% annually every year without, the downside risk, right? And a steady amount of income. And, if you are new to investing and, looking to use that pot of money for something as important, as buying a home, then you don't have a long time horizon, right? It's a shorter time horizon. Then, essentially it could be very risky, if you invest your CPF money, which is essentially, we can consider as your kind of bond portfolio portion of your larger portfolio, right? Makes more sense, to invest money which is not guaranteed to get that 2.5% return. I'm not sure if you have a different view.
And on the qualitative side, which I think people often forget, if you invest money trying to make something for your upcoming wedding, then with COVID, it has shown that you don't really need a big weddings. And if you're willing to compromise and have a smaller wedding, if the markets don't recover and you lose money, then that's okay. But with a house, it's a completely different ball game, right? Like the downside of if the markets were to continue to be depressed, and the time comes for you to buy your house, are you going to be happy downgrading? And if you say that, okay, my spouse and I have discussed, we'll take this risk. Okay, we'll get a smaller house in a less than ideal location if that's the case. But think of that emotional drain it's going to have on your marriage in the very early start. Yeah, I don't think that's a good idea. And, like the disgruntled spouse will then always be thinking, you lah, why you invest our money? I tell you no already, right? And that will always just be at the back of your mind and it eats you up from the inside. So yeah, from that emotional perspective, I wouldn't do it.
Oh, no, good points. So yeah, I think that's all the time that we have for today. And thank you, Don. Thank you, Sam. Thank you everyone for joining us today. If you do have any other questions, you can still reach out to us and we'll help. Yeah.
Thanks very much.
Bye.
Thanks, Dawn, and thank you very much for joining us today.
Thanks, everyone.
Thank you.
All right.